Hello friends, we'll continue with cash flow statement, right? And we have discussed so far cash flow from basic two activities. We have discussed cash flow from operating activities, right? And we have discussed cash flow from investing activities. Clear? So we have discussed two activities, that is operating and investing activities, and in the very beginning of the chapter I told you we calculate cash flow from three activities: operating, investing, and what is the third one? Third one is financing activity. Third one is financing activities. Clear? So we have done these two. We have completed with operating and investing, and in this lecture we'll be starting with cash flow from financing activities. Right? We'll starting with cash flow from financing activities. Clear? So now, what is cash flow from financing activities? First, we need to understand what are the financing activities. Right? Now, listen to it very carefully. You are a businessman. You are running a business. Your business is doing very good. You have a good standing in the market. Right? You are running a business. Your business is going very good and you have a good position in the market. Now, one day you decide to expand your business. Right? One day, what you take decision, you want to expand your business. Right? Like you say that you have a business in Mumbai. Right? Your product is doing very good in Mumbai. Now what you decide is you want to open your business in Delhi also. Right? Once you see that your product has gained a lot of popularity in Mumbai, you have decided that you will expand your business and you will set up an office in Delhi. Right? So you are going for business expansion. Now, for this business expansion, you need approximately 5 crore rupees. Right? Say for this business expansion, for setting up an office in Delhi, you need 5 crore rupees. Right? And you checked your pocket. Right? You have only 1 crore. You checked your pocket, you checked your bank balance, you have only 1 crore with you as your own fund, but you need 5 crores. Now, how will you get the remaining 4 crores? Can you tell me? You want the business expansion, you are ready for setting up an office in Delhi. For that, you need 5 crores, but when you checked your pocket, you have only 1 crore with you. How will you acquire the remaining 4 crores? You might say that, sir, we won't open an office in Delhi. No, my friend, we have to open this office in Delhi because our product is going very good. We need business expansion, but we need 4 crore also. Now, how we are going to get this 4 crore is, we will borrow money. Isn't it? We will borrow money, say we borrow from bank. Clear? Now, if we are borrowing the money from the bank, we call this as loan. Right? So, In the financing activities, we are going to talk about the loan taken by the business. Clear? Now, this money can be borrowed in three ways. I can say this loan you can take from three ways. I don't say that we are taking it from bank. I say this loan we can take it in basically three ways. Right? One is share capital. The second is debentures. And the third one is loan from bank. Now friends, I am doing this chapter before shares and capital. Right? I got a request from some of the friends to do cash flow first. So I am doing cash flow first. Otherwise, I would have done shares and debentures first. Now, so I will not be going detail into shares and debentures. I would just say that shares and debentures are the documents on the basis of which we can borrow money from the public. Right? Share capital and debentures. This is a document on the basis of which a business can borrow money from public. Clear? We issue this document to the people who have surplus money. They are ready to invest in our business. They are ready to give us the money. We give them the document. Like you go to any shop, you buy some product, right? And they give you the receipt. Isn't it? You buy the product, you give them the money, they give you the receipt for the money paid. Isn't it? So share capital and debentures are like the receipt. You are issuing the receipt to the public for borrowing their money. You take the money from the public and you issue the receipt. That receipt is known as the share capital or the debentures. This is our capital only. Right? This is the investment of the public, but we call this as share capital, and debentures are also like the borrowed from public. Right? They are like loan only. Loan we take from bank, and debentures we are taking the loan from public. Right? We will do share capital and debentures in detail when we go to those chapters. Right? So basically in the financing activities, what we are going to deal with is the items that are directly affecting our finance. These items, when we are borrowing the money, that is directly affecting our finance. We need finance. We need 4 crore rupees. For that we are taking the loan. Loan we can take in three ways: share capital, debentures, and loan from bank. Share capital is further, I can say, consists of two things. One is equity share capital and one is preference share capital. Right? This in detail we will do in the chapter of share capital. Right? Now, in case of financing activities, what we are going to deal with is the items which are directly affecting our finance. We need finance. We are in the need of finance. Finance means we need 4 crore rupees. From where we are going to borrow these 4 crore rupees, we will either issue shares and take money from the public, we will either issue debentures and take money from the public, or we will take directly loan from the bank. Clear, friends? So, if we talk of cash flow, let's see what are the cash inflows. What are the cash inflows and what are the cash outflows in case of financing activities. So now I have told you that we are going to deal with three things: share capital, debentures, and loan from bank. Share capital, it is the public money. We issue the document and we borrow the money from public. Same way, debentures also we are borrowing from outside, right? This is our outside liability, debentures. This is a borrowing, long-term borrowing, okay? Now, what are the inflows? If we talk of share capital, we are issuing the shares and we are borrowing the money. The money is coming into our pocket. So it is a cash inflow or outflow? It is a cash inflow. So I can say issue of shares is a cash inflow. Issue of shares. This is increasing our capital, okay? Now, talking of debentures, if we issue the debentures, you are issuing the document and borrowing the money from outside. The money is coming in. This is a cash inflow again, issue of debentures, right? Issue of debentures. Now, talking of the third thing, loan from bank. If you are applying the loan from bank, you take loan, the money is coming into your pocket, isn't it? The money is coming into your pocket. So, loan taken. Loan taken is cash inflow. Anything else in cash inflow? No. Now let's see about the cash outflows, share capital. Talking of share capital, we have equity and preference share capital, right? What we say is it is a document given to the public who are giving us the money, right? So we have taken the money of public on the basis of that document can anytime ask for their money back, right? Clear? Public to whom we have issued that document of share capital, they can ask for their money. It is their money that we are using in our business as capital. Clear? So that is a cash outflow. We have to pay money to the public. It is their money. We can't deny them their money. Clear? So I can say payment for redemption of, see, redemption is for preference shares, right? And second term we use is buyback of equity shares. What is meant by buyback of equity shares? Your company is having shares, that document is given to public and we borrow the money. Tomorrow what we are doing is we take back the document, we buy back the document and we pay the money back to the public. This is buying back our document. That document is known as equity share capital. Clear? So we can say buyback of equity shares. Now for the debentures, again what we are doing is the public can ask for their money and we will have to pay them. That is redemption of debentures. Clear? Redemption of debentures means we are taking back the debenture document and we are giving back them the money. So it is a cash outflow for the business. Talking of loan, you have taken a loan, now you have enough money to repay the loan. If you repay the loan, that will involve cash outflow. So I can say repayment of loan. Clear? Now, you might say that, sir, it is complete. No, sir. We still have a few things. Now, if you are borrowing the money from the public, you will have to pay them something extra, isn't it? If you take a loan from bank will charge interest. Similarly, the money that is given by public is not free of cost. They will charge you interest, isn't it? If you are borrowing the money from the public, you will have to pay interest on that money to the public. Otherwise, public would have invested that money somewhere else and earned the income. You were in need of the money, you bought that money from the public, and you will have to pay something to the public in addition to the principal amount borrowed. You will have to pay interest to the public, isn't it? Clear? Now, that interest payment on share capital is known as dividend paid. On share capital, the interest to be paid is known as dividend paid. So that is a cash outflow for us. There are two types of dividends. One is interim dividend, that is dividend paid during the year. The second is final dividend, that is dividend paid at the end of the year depending upon the profits earned. Clear? Interim dividend is paid during the year and final dividend is paid at the end of the year depending upon the profits earned. Clear? Talking of debentures. On debentures, we will be paying interest because again we are borrowing the money from outside and we have to pay them. It is a loan for us, right? So, on debentures, we will pay interest on debentures. Right? Then, talking of loan, on loan, if you borrow the loan money from bank, you have taken a loan from bank, you will have to pay interest to the bank. Simple, right? Interest on loan. So these are the cash inflows and the cash outflows in case of financing activities. That means the activities which are directly affecting the finance of the business are the financing activities. Basically, in financing activities, you have to remember that we are in need of finance. We need 4 crore rupees. Now, how to get those 4 crore rupees is we can issue the shares, we can issue debentures, and we can take a loan. There are 3 methods, right? If you are issuing the shares, debentures, or you are taking the loan, that involves cash inflow. And the opposite of them, if you are redeeming the preference shares, if you are buybacking the equity shares, and if you are doing the redemption of debentures or repayment of loan, that will involve cash outflow. And any expense, the interest, we are borrowing the money from public, you have to pay interest on that money. In case of share capital, we say it is interim dividend and the final dividend. This is basically the interest to be paid on money borrowed from public. On debentures, we will say interest on debentures, and on loan, we say interest on loan. Clear? So these are the cash inflows and the outflows when we talk of cash flow from financing activities, and the net of cash inflows and cash outflows we get as net cash flow from financing activities. Clear, friends? Now, one important point here is that in case of issue of shares, it can be at a premium. That means a rupee, one share can be sold at rupees 5. 100 rupees share is sold for rupees 105. Right? That means for one share, people are ready to give you 105 instead of 100 rupees. If you take that one share, to the market, you will get 100 rupees. And if you if you take one share and go to a particular strata of people who are interested in your business, they are ready to pay you 105 rupees. That 5 rupees is the premium that you get. Clear? I'll repeat again. You take one share, you take one share to the market, they are ready to pay you 100 rupees. That means the market value of your share is rupees 100. Now there are some specific people who are ready to invest in your business Why they are ready to invest in your business? Because your business is doing very good, and they are in the hope that you will earn good profits and pay good dividend. So there are some people who are ready to invest your business, and they are ready to pay you 105 rupees. That is 5 rupees more than the market. That 5 rupees is the premium on shares. Clear? So while issuing the shares, when we say cash inflows, we will consider the premium also, because that 5 rupees is also coming into our pocket. Clear? Similarly, in case of debentures also, we will consider premium but not consider discount. We will not consider discount. Why we are not considering discount? Because in case of discount, there is no actual cash outflow or inflow. In case of premium, we are getting some extra money into the pocket, but in case of discount, there is no cash outflow. In case of premium, there is a cash inflow, but in case of discount, there is no cash outflow. Clear? So be careful that we have to take the premium amount, we have to include the premium account while issue and also while redemption. While redemption also, there can be a premium that we are giving more money to the public because our business is doing very good. Right? Clear, friends? So this is how you do cash flow from financing activities. Basically, it relates to the items which are affecting our finance. We are in need of finance. Just remember one thing. We are in need of finance. We need finance. We need 4 crore rupees for business expansion. How we are going to get those 4 crore rupees is, there are 3 ways. One is share capital. Second is debentures. Third is loan from bank. The shares and debentures we are taking from the public, we are taking from outside. Loan we are taking from bank. Clear? To the outside public, we will issue a receipt, we will issue a document, share document, and on the basis of that, the public is interested in investing their money in our business because our business is doing very good, and they really hope that our business will earn more profits, and because more profits, they will get more dividend. What is dividend? Dividend is the interest that is payable to public because they are lending the money to us. Clear? If you borrow money from the bank, they will charge you interest. Similarly, you are borrowing the money from the public, you will have to pay something to the public. Their money is not free of cost. Remember this. Only then you will, maintain your position between public. Okay? Clear, friends? So this is how we will be doing cash flow from financing activities. This is a very simple one. Even investing activities were very simple. Financing is very simple. The only technical part was operating activities. But I hope I have tried my best to cover all the concepts. Clear? So if you have any queries regarding this, just send me an email. You can email me at ksjteaching@gmail.com. Right? Clear, friends? In the next lecture, we'll be doing practical problems on financing activities, and thereafter we'll do a practical problem covering all the 3 activities in one. In the next lecture, we'll do practical problems on financing activities. Clear? So that's all for this lecture, friends. Thank you so much.